Good day. I'm Martin Gagel with Market Radius Research. It's Thursday, May the 4th. And we've got CEO Patrick Wood of Delphx Capital Markets joining us. Delphx is a fintech company providing credit and risk solutions for the capital markets. Pat is here to explain his business and the growth plans. With the recent credit risk and seen around the world and within the global banking system, this story is very timely and could be exceedingly relevant. I've honestly never met a company with this type of a business plan model before, so I'm very excited to get into things and really understand how things work. But please remember, it's neither recommendation nor investment advice. We're here to learn about the company. Pat, thanks a lot for joining us, and let's hear all about Delphx.
Thanks so much. Hello, everybody. Thanks for taking some time out today to hear our story. For those who have been following us for the last couple of years, we've been really careful not to do these types of presentations. And the reason being is just, we could talk about our product, we could talk about some of the things we were doing, but until we actually had some real traction, there was a reluctance to really go out and broadcast, from the hilltops that, we're really turning the corner, we're accomplishing our mission. And so today I'm absolutely thrilled to announce, and it's further to a press release we put out a few days ago, that we are really now in a pathway to actually commercialization of our product. And it goes beyond that, and I'll explain a little bit more as we kind of conclude the presentation about where that's headed. But as a lot of you guys know who've been following us, it has taken quite a few iterations of our product before we finally got it right. Philosophically, Delphx shouldn't be in the business that it's in the sense that, any new credit inventions on Wall Street were invented in Wall Street by dealers. Being an external company, and having the uniqueness of developing credit products for Wall Street, it certainly, rocks the boat, and it changes the general narrative of, Wall Street developing these products. So what we have been able to do, though, is we've been able to get our product to a point where there's a huge market demand for it. As Martin just noted, the timing couldn't be more right. We think the timing is going to, afford us, some great upside going forward, certainly into the end of the year and possibly beyond as credit markets deteriorate, which they really are bombing. As I was talking with the guys before this call started, you wouldn't notice it with the broad indexes today, but credit markets are being decimated. Everything from commercial real estate bonds, straight through to, as you guys all know, regional financial banks, and that kind of contagion. Once it starts, it's really hard to stop. And so, to be in a position that we're in, allowing investors to protect and speculate on rating changes, which is a one-of-a-kind product, nothing like us exists, it is a huge winning position for us. And as I mentioned, as we're on the cusp, and we actually have a real tangible and a real meaningful pathway forward to get commercialized in the very near future. The time to share our story is really now. So with that, I think, some of the history of Delphx, as most guys who have been following us know, is that, we originally started with a default security product. The original aim of the company was to really combat the credit default swap market, in the sense that credit default swaps, they're a tool that has been used, by Wall Street, for over 30 years now. And as such, I would say the weaknesses in credit default swaps have really kind of shown themselves over the years. And the main thing being, of course, that, credit default swaps, you're relying on counterparty risk. There's always the risk that whoever's insuring you against default, that they're not going to have the balance sheet to support you. So our original model was to have a fully funded credit default swap. It was something that resonated with certainly some of the large insurance companies out there. But Wall Street itself, dealers in particular, they were loath to take on a new product. Call it complacency, bandwidth problems, whatever. There was never a real push there from those banks to move forward with us. And so everyone would digress back to CDS being an unfunded instrument. Wall Street loves leverage. And that's where that product, really hit a wall. Now, we still think it's a great product. We certainly know that there's appetite, among a sector and a group of people who are, big, large institutional portfolio managers. But, it just doesn't have I would say, the zing that our new, credit rating security product does. And so in the process of developing that default product, Delphx, one of the things we really did, certainly, after I took over from the past regime, is we really listened to Wall Street. We listened to what investors wanted. We listened to flow desks in New York. We listened to where the pain points were for certain investors, that manage credit portfolios. And everything came back to one thing, and that was rating changes. Rating changes, there's really, guys get smacked when bonds get downgraded. Not only do they lose value, obviously, on those bonds, but they also, are getting nailed with capital charges, forced sales, all those kinds of things. Now, CDS does somewhat of an interesting job in protecting investors against that type of risk, but there's no trigger in CDS other than default. And so our product really focuses on a specific downgrade of a specific bond, and the parameters of that bond, and that downgrade are laid out at the issuance of the two securities. So once again, we are a very unique product. Nothing like us exists out there. And by virtue of listening to investors and listening to the sell side, we've been able to create a solution for them that really covers off their pain points and makes this a very exciting new entrant into the market. And hence, like I said earlier, we now have a pathway forward with groups who are going to start using our product and start, using, credit rating securities in a transactional basis, which is a revenue generating moment for our company. Like I said, in the very near future. I will say the only thing holding us back from issuing our securities today is just that we're completing legal documentation with our counsel at Latham & Watkins. We think that the timeline to have all those documents completed are in the next couple of weeks or so, but that should be enough to give everybody on the call, a clear indication of when we're going to be kind of moving forward and actually doing live transactions. Now that leads to a lot of other things down the road, and I'll touch on those after we kind of shoot through what our product is and what we do. I'm just going to move over to my slide over here. I hope everybody can see that. Martin, you got that? Just give me a nod. Okay, great. I'm gonna zip over to and guys, anybody can get this presentation from our website. It's on the investor section, so pull it up yourself and have a look through it, and then obviously send us questions. But I think it's important to start with what we do as a company and why our solution is so needed right now and so attractive. Delphx in and of itself, is the major company here. I mean, we're the publicly listed company. Under us, though, are a couple of wholly owned subsidiary companies, one of which is Quantum. And Quantum is a special purpose vehicle. It's a Delaware LLC. It is an issuer of securities. We've got two proprietary securities at Delphx. These are securities that have been developed over the years. We have a ton of IP and provisional patenting around all of our processes, which is great. We continue to beef that up as much as we possibly can. But in essence, though, what we do as a company is we're the kind of, I would say, the middleman in a process that occurs between two sides. On the one side, you've got what we call a CPO, or think about it as a put option. And when that put option is created, it's essentially married to a CRN. Think of the CRN as an option writer. I think everyone understands equity options. Think about this as equity options coming out of the gate here. What we do is with this put option will give an investor the ability to protect a loss on a certain trigger that would occur within a bond, that if it's hit, this investor will capture, like I said, he's paying for protection. He's going to get that protection paid back to him. So the amount of coverage that he's paying for, he's going to get paid over to him. And I'll explain that a little bit more in a sec. On the other side, though, you've got an option writer. And that option writer is essentially He's saying, look, I'm comfortable taking on the risk. I'm going to put up a maximum amount of collateral. Let's call it my maximum liability, so that if the trigger that we've decided at the outset of this structure, if it's actually hit, I've got a fund here that will pay you whatever it is, whatever, that loss is going to be on that trigger being hit. In this case, we've used an Oracle bond. Let's think about it as a 1-year Oracle bond. That bond today is rated BBB by S&P and Fitch. So in this narrative, and once again, these are all just, example numbers. So don't take them too hard as far as, how much the guy's paying $1.5 million for $7 million of coverage. Think of it more like this. This guy is worried that that bond is going to go from BBB to BB. And so for the next 12 months, he's got, 200 million face, which is, 200 million of Oracle bond that he wants some protection on. And so if Oracle goes from BBB to BB, which is below investment grade, he's saying, you know what, I'm going to pay $1.5 million so I can sleep well at night, to some degree that, that Oracle bond, if it does get downgraded, I'm going to be covered for a lot of that downgrade loss. On the other side, though, this investor is really saying, look, I'm happy with that Oracle bond. I could be a hedge fund. I might already own that bond, and I'm looking to boost up my returns. So I'm going to put up, in this case, $7 million of collateral. That's going to sit in a U.S. Treasury, kind of a money market account. And I'm going to keep it there so that if that bond, goes BB, this whole structure gets triggered and this investor is made whole. In the middle is Bank of New York Mellon. They're our custodian. They handle all the cash flows of this, essentially this structure. Quantum, our SPV, is simply in the middle. We issue both of these securities as any private placement security would be issued in the US. We use an exemption called the SEC 4A2 exemption, which allows us to issue private placement securities to qualified institutional buyers. This is an institutional investor product, clearly. This is not for the retail, mom and pop out there. And so Delphx, though, as an SPV in the middle here, and through our broker dealer, we can act as a placement agent for this structure. And our broker dealer is actually laid out to do private placement issuances. We essentially will take 10% of that premium. That's our business model. So I don't show it in the diagram here, but out of $1.5 million, Delphx would immediately take 150 grand. And that $150,000, we pay our custodial fees and legal fees out of that $150,000. And in a structure like this, those fees would amount to about $35,000. So the net remaining $115,000, we share with the dealer. So if it's 2 dealers, we'll take half and share, the other quarter with each dealer. If it's 1 dealer structuring both of these, then we'll obviously give the other half to that 1 dealer. That, in essence, is our business model. That's how we make money. This structure, by the way, because investors are looking to protect short-term downgrade risk, this structure is fantastic for heavy volume transactions. Because the fact that this structure is about a year before it matures, there's no real problem with liquidity here. The liquidity becomes very transparent. Whereas in a credit default swap environment, liquidity is, it's one of the biggest issues because they're generally put on for 5 to 7 years. There's a lot that can, happen in that 5 to 7 year period. Liquidity is a big issue. In this case, like I said, these are going to be very short-term structures, and they're going to happen all the time. And what that short-term structure does is it allows us to make a heck of a lot more money, but it also allows the dealer now to make a lot more money. So if you're sitting on a flow desk in New York and you're looking at transactional volumes, CDS is good because CDS has been standardized, but any other kind of default instrument or structured product is sleepy as heck. It's not exactly going to be easy to get liquidity in that kind of an environment. This product's a dream, though. You can bounce this stuff back and forth all day long, which, once again, it solves the other issue, not just the buy side issue of giving them something that covers off their pain point, but it also gives dealers an opportunity to really, boost up their P&L. And Wall Street is only about one thing, is P&L. So this product is a dream for that. I'm going to switch to the next slide because I want to explain a little bit, what happens when a trigger is hit. So when this Oracle bond goes double B. Now, understand something. Bonds are really traded in spread. They're looked at in spread. And so when the spread on a bond is quoted, let's say 100 beeps, in this case, let's say that, the Oracle bond is trading at 100 beeps over the next year. What that means is that if the risk-free treasury rate, so the 1-year treasury is at 4%, that Oracle bond is yielding 5%. That's the way to think about it. And that's spread. And everything on Wall Street is measured by spread. Nobody really gives a darn about price. And so looking at how this is, essentially, how this is unfolded in the event of a downgrade, we'll look at spread. So in this case, okay, if Oracle goes double B, if it's either S&P or Fitch, once again, there's malleability to this product. So up here, we've got Oracle rated triple B by S&P and Fitch. These two investors at the outset of this structure, and it's in all the documentation, et cetera, they will decide, okay, is it going to be S&P or is it going to be Fitch or is it going to be S&P and Fitch who have to downgrade the bond to double B? Once again, that's predetermined at the structure. But in this case, let's just assume that S&P and Fitch have downgraded the bond at the same time to double B. So what happens in that situation is the spread on the bond, so that Oracle bond, so at the outset, let's say that Oracle bond, the risk-free rate was 4%. Oracle was yielding 4.75% at that point. So the spread in this case has gone up 300 basis points because that Oracle bond is clearly much more risky. It's gone to high yield status rather than investment grade status. So once again, there's going to be a big widening in the spread because investors are not going to, sit with 4.75% on a double B bond that was rated triple B. They're going to want a lot more, let's call it juice, to hold that bond now than when it was in triple B status. So the spread has changed 300 basis points, and on 200 million, remember, this investor was looking at 200 million face coverage on that bond. On 200 million, that spread difference has basically created a loss of $6 million. So in that case, the note investor, so let's call him the option writer, is now going to pay that $6 million over to this side. He doesn't really pay it, by the way. Bank of New York Mellon manages everything. So Bank of New York Mellon gets instructions. They send it over to the other side. And because he put up $7 million of collateral, he keeps $1 million. So net, this investor who put up $1.5 million worth of protection walked away with $4.5 million. So he saved some of the loss that he incurred in that bond. On this side, this investor captured the premium of $1.5 million, but he also kept $1 million of his collateral. So net, he's out. What is that? $4.5 million. So actually, sorry, not 4.5 million. He's out $3 million because he kept the premium. So that is a, that is actually, sorry, wait a minute. He's out 4.5 million. Sorry, guys, it's only coffee one so far this morning. So anyway, so getting back to this structure, the trade is then completed. And so you see the win for this investor if that downgrade happens. You see the win for this investor if the downgrade never happens. There's no two winners in this structure. There's always going to be a winner and there's always going to be a loser. And that's the way how it should be. There shouldn't be an equal win between both of these participants. That's not how that's not how the world works. That's certainly not how credit trading works at all.
And this is essentially insurance and an insurance product that you're buying, and then if an event happens, you get paid out a certain amount. And if it doesn't happen, then the underwriter gets to keep the fees.
That's exactly it. 100%. That's exactly the way to think about it. And as an insurance product, you got to think, who's the buyer of this product? This is an insurance company, 100%. Insurance companies, they are looking to de-risk their portfolios of hundreds and hundreds of bonds nonstop. This is a dream solution to them. So if you're an insurance company and you own that Oracle bond, if that bond goes to double B, you're getting punished on the spread. So the spread has increased 300 basis points. So you're getting hurt there. The other place where you're getting hurt is on capital charges. Insurance companies are regulated, in a different way than normal people are, in the sense that they're beholden to very specific regulations, and one of them is that they're not allowed to hold bonds that go to high yield status, and high yield is anything below triple B. So they get a thing called capital charges, which hits them. So they actually get nuked, not only on the loss of the bond, but they get nuked on the capital charge as well, because that bond has gone to double B status. The other thing that's really important, and to note too, is it's generally going to be in their covenants. And certainly, the insurance regulator will insist that they sell that bond. So selling that bond after it's gone to double B, I mean, good luck. I mean, that bond has gone to high yield status. Certainly the bid and ask on that bond is going to be markedly different. So it's a big loss when this event actually happens. So we, as an issuer of these things, let's call us, like I said, the guy in the middle. We're simply issuing these things. We're creating and solving a problem that doesn't exist today for that insurance company, and then for the hedge fund, who's looking at fast returns. This is a dream product as well, because on $7 million of risk, he's gaining $1.5 million for 1 year of risk. That is a dream product for hedge funds. They love the fact that they can do this all day long. And I should note too that both of these, they can be broken down a bit, particularly the CPO. This thing can be tranched down. So if this investor is looking to piece this $1.5 million out down the road, as far as his holding in the CPO, he can do that. The CRN a little less so, but it still can be sold from one investor to another. So there's a natural, like I said, liquidity in both of these, just by virtue of the structure. Downgrades, because downgrades happen all the time, unlike defaults, which are very, very rare. Two, though, is the tenor of the structure, and essentially, keeping it short term. This thing is just, like I said, it's a dream for those guys. Now, there's another possibility here, and the other possibility is that that Oracle bond actually, it goes from triple B, let's say, to D. I'm not throwing cold water on Oracle that they're going to go default anytime, but just there have been situations where bonds really just go straight down the tank. Notably, if you look at some of the bank bonds, the regional bank bonds, and some of the recent FDIC takeovers and interferences, those bonds have lost many notches, literally overnight. And so we've seen that kind of that kind of thing transpire before. It's clearly happened. So in this case, though, let's look at, actually, I'm not going to use this as an example, but what I will say is that if this bond, if it blew out and if it went to, let's say, double C, the loss would be a heck of a lot greater than this $7 million of collateral. So the spread on the bond, forget about going up 300 basis points. It'd probably go up like 500, 600, 700 basis points. In that case, there's not going to be enough coverage here to cover that loss, but that doesn't matter. In this structure, this is the maximum amount of liability that this investor's put up. So there's no other tail risk here. There's no other counterparty risk. There's nothing outside of this that allows shenanigans of any kind, which we have seen clearly in other structured products back in the day, in particular, notably CDS. So.
And what it's not insuring per se the loss of if it gets downgraded, it's insured for $7 million in this case scenario. So if whatever weird market things transpire, they still get their $7 million, or the $7 million transaction happens, or if it goes bust, it's only $7 million. If
you got it, man.
They get
Bingo.
taken out the next day, it's still $7 million. It's just what it is.
Exactly. So this is a very simple structure. I mean, I have an easy time explaining this to my 14-year-old daughter. A default product, a credit default swap, a CLN, CDOs, etc., not so easy. You're dealing with recovery values, auction processes. I mean, a whole bunch of things that come into play. But what's beautiful about this product is it's simple. And it's a trading product. You've got somebody putting a bet on each side here. And you know, the way, and I shouldn't say Wall Street, it's more Midtown now, but everyone still calls it Wall Street. But you know, the way that these, you know, kinds of credit dealers and others work is they're looking at a high velocity trading product. They like to put bets on things. And at the same time, insurance companies love to diffuse their risk as much as they can. So this product is the only one of its kind. There's nothing like us out there that does this kind of thing. So our biggest challenge, so I'll kind of stop it there for a sec. That in essence is the Delphx product. And I think it's pretty clear that, like I said, we spent many years getting to this point. And finally, like I said, you know, we're here to tell the story now because we finally have a version of our product that actually has appetite and that's actually going to move forward. And Wall Street does have a big problem right now, and that is that the credit markets are going completely bananas. They're much worse than 2008 were right now. And I think it's going to get worse too. So,
Pat, with that $7 million under this scenario you've laid out, is there any counterparty risk where the hedge fund that's the underwriter doesn't pay, or is that $7 million put into escrow at BNY Mellon or anything like that?
yeah, correct, Martin. That's exactly correct. That 7 million, it's held by the custodian at Bank of New York Mellon, and it's going to be held in a money, you know, treasury bill fund type thing. You know, and so there is no counterparty risk here. There's no risk of, you know, oh, that hedge fund can't come up with the liability. Like I said, this is all structured at the outset, and that's one of the reasons why we're able to issue these as securities and remain under SEC, not CFTC jurisdiction. We're not a derivative like a credit default swap. We're certainly not a swap product. We're issued as a security, a fully funded security, which, like I said, gets us the, you know, the badge that, you know, we get to issue these under 4A2. Which, by the way, I mean, to Wall Street, it doesn't mean a difference at all, whether you're a derivative or a security, but we'd rather be as an organization more, you know, kind of regulated by the SEC rather than the CFTC. So it makes life a lot easier. So with that in mind, guys, you know, our biggest challenge as a company over the years has been to really get buy-in from the street and really have a pathway forward where, you know, dealers said, we're excited about your product. You know, we want to take you on. We want to sponsor this. We want to, you know, get this going. The biggest challenge for us has been talking with those dealers and them really just not having the bandwidth to take on a new product. And there's lots of reasons for that. But the one thing that I will say, and this is, you know, this 100% Wall Street type stuff, is that when you have a product that's actually generating P&L and investors see this hit the tape, that you're issuing these new securities, literally it's a come one, come all. And we've had discussions with some of the largest primary dealers in New York, and it's consensus 100% that once we start generating revenues through this product, everyone's going to want to get behind it. And so that's what we've been able to do with Cardiff Associates. Cardiff is led by a very brilliant team, some of the strongest and finest resumes on Wall Street, and some of the finest, I would say, most brilliant kind of, you know, forward thinkers getting behind us and assembling, you know, like I said, this, I would say, a contingent, a group, a conglomerate of, you know, early stage users of our product, which, you know, like I said, could start tomorrow as long as we have the legals done. And certainly they are going to do this for us, which is very, very exciting. The other thing, though, that is very exciting about this product is not just that it's a new product. It's going to, you know, once again, resonate. The timing is right. It's a cash monster because it's going to generate a lot of dough for our company. But it's also the fact that, you know, we are essentially a new category, a new asset category. And if you can think about this category coming onto the markets, you could do a lot with this down the road. So if you read carefully our press release with Cardiff, there are quite a few milestones in there, which include us becoming a whole new asset category, and getting us through that big step, which is something that like I said, if you understand the revenues and essentially, you know, how this product is going to generate revenues, it makes us just absolutely monstrous going forward. And I would, follow that up with, our total addressable market is in, the many, 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 many trillions. And so to capture just a small portion of that, it's essentially a very meaningful outcome for the company going forward. So otherwise, we have de-risked the company to a large part by, once again, being, very thoughtful in developing these products with buy-in from the street. And then also, I think it's very important to note that, our company going forward, we have to finish our legals, and the legals have already been done because, as most guys know, we've already done a trial issuance of our default product. So it really is an easy process to get those legals turned over. But once that's done, I mean, we really start revenues. So if the legals were done tomorrow, we'd have revenues the day after. And that's how fast we know that this is gonna come out now. So once again, it's the time for us to share the story. I'll kind of stop there and see if we have any questions.
Sure. This is going to be kind of a one-off product where someone with a bond says, hey, we need some protection. Walk me through what the bond, presumably it starts with the bondholder. I guess it could start with the private, the underwriter, call them. They say, crap, I've got all these Oracle bonds. I need some protection on it. They phone you up, they phone Goldman up and say, hey, let's say they know about the product. I need this. Can you find me the Delphx protection product to go along with it? Or how do the buyers and sellers get matched up?
Sure. So at the beginning, we have a group of investors who are going to do this between each other. And these actual issuances are then going to be so they'll be shown not just through their own ecosystems, but in some of the largest market, I would say, coverage kind of platforms out there. So any credit market platform is going to actually have these securities actually listed on them, and that in and of itself is going to be a big thing for visibility. The second thing, of course,
sorry, just to clear it up, the underwriter is they're gonna create a whole basket of these for certain bonds that they feel that there'll be an appetite. Then they're gonna go to the bond holders who they know they hold these bonds and say, hey, look at this product we have. Are you interested in it?
Yeah. So Martin, every single primary dealer on Wall Street, they really do kind of cover the same kind of accounts, and the same names, et cetera. But let's think there's 8,000, actively, kind of managed portfolios out there by, large institutions that, the primary dealers would cover. Those primary dealers, they know exactly who their client base is. They know exactly who's got the pain points out there. They know exactly, who's got the risk appetite. And so this is an easy, it's an easy mix and match for these guys to get behind it. It's very easy to buy the option. We know that there's a massive appetite for the option out there. Historically, the underwriter or the put writer, the guy writing the put, that's generally been one of the primary dealers. But that whole narrative changed, going back over 12 years ago. It became much easier in a low rate environment just to buy indexes. So guys got away from single name type stuff, which is only really haunting them now, because right now single names are getting pounded. And so this is where this product really kind of comes in and fits the bill. But what essentially happens, Martin, is when you have P&L being generated by a product and Wall Street sees that P&L, they will then become the option writer themselves. So the big banks will be the option writer, just as they are with credit default swaps, and they'll assume that liability. And so that's where you get the very, very heavy velocity come out of this product. But we're not going to those dealers at the outset. We have, friendly accounts that are going to start doing this. And these are massive multi-billion-dollar accounts too, mind you, that are going to go and really get this done for us as partners going forward. And that in and of itself, like I said, gets the product moving very fast, gets revenues in the door immediately. And then we know from discussions we've had with the large dealers that they'll take the product on at that point. So So that the issue is not who's going to buy the option. We've always known that it was who's going to take on the bloody liability.
Yeah.
And like I said, banks have generally done that, or the dealers have, but they haven't done this type of thing for a very long time. Now, if we can show them that this is working again, they'll get behind it in a big way. So.
All right. There is a question here. You did address it somewhat, but let's maybe clarify it a bit more. The question is, will there be a secondary market to trade on the value of the SPV? So
value of the SPV? No, that doesn't. So the special purpose vehicle, guys, is really, it's just an issuer. It sits in the middle. Think about it. I mean, I hate to say it, think about it almost as a bookie. Okay. But the SPV is not taking on any liability here. It's simply issuing the documentation. It's getting instructions from both sides and putting that together, assembling the documentation, informing the custodian that this has been done, and that's it. At that point, the SPV, it's once again, it's a standalone entity. It has no value really. In fact, I mean, anybody can create an SPV. It's the easiest thing out there, and there are tons of them out there. But its sole mission is, once again, just to issue these new securities. And by virtue of having a broker dealer that is allowed to do private placements, so we're regulated by FINRA and the SEC, of course. We're able to share and generate these commissions and take fees as any other broker dealer would.
Right.
And we're able to act as the placement agent. Thus, we capture all the revenues at our top line, and then if we're sharing the dough with the dealers, we'll then piece it out from the bottom line. But yeah, all revenues go to us on the top line.
All right. And so you're waiting for all the legal work to be done, and then you're going to put together some product. And with sorry, it slipped my mind, the sort of distributor you just announced last week, I believe it was. With them, you're going to work to sort of market the securities.
So take a step back. So it's not a distributor, it's a partner. Cardiff Associates is a partner of ours, a new partner. Yeah. They are very, very experienced, and they know and they have a pathway that we are very excited about, because they know exactly how this is gonna evolve and where this product is gonna go. And they're able to get us there. Unlike ourselves, we do not have the same types of I would say depths of connections and things that these guys do, and the ability to do these transactions right out of the gate. And they certainly do. So we couldn't be more excited that we've partnered with these folks. So it's great.
All right. Okay, well, that seems pretty straightforward. You're not putting up your own capital. You're matching sort of buyers and sellers of these securities and taking a clip. That sort of broad model is fairly well understood on Wall Street, and you're creating value with these new products, and it's going to launch in a few weeks or months.
I'll tell you that, like, the minute we have the documentation in hand.
Yeah.
So like I said, the documentation has been done before. On our default product. It's virtually identical. The products. The only thing that has really changed are the triggers. So.
All right. Okay. So is that it for Delphx, or any, like, you're gonna run with this product, build out its?
Great question, Martin. So we're starting with corporate bonds, because that's low overhanging fruit, but the malleability to this product is pretty heavy. So there's a versatility here that we can actually move this over to municipal bonds. We can move this to private debt. We can move this over to a whole group of other categories out there. And that is certainly within our plan. The other plan, of course, if you look at our most recent press release about Cardiff, has us doing a lot of other very interesting things down the road. And so as we grow as an organization, as we get these products moving, we're going to be in a very, very strong position to build out and continue adding value through new product lines, and covering off, like I said, other sectors, other groups, other regions, of course, because, this is a US product right now. So there's no reason why this can't go, Europe, Asia, all over the place at some point. And so.
All right. How about tell us a bit about the company here, the capital structure, that sort
Sure.
of thing.
So that's a good question. I think we have about 140 million shares out. On top of that, we got a whole mess of warrants and options. Options mostly are out of the money, as I think are most warrants right now. That being said, we've done no real marketing in the company until now. Now is when we're actually going to start doing some marketing. So I think that the share price kind of I would say that the way that the shares have been trading will start to reflect success pretty soon. That being said, if we are going to raise any capital, which I think we will, it will be on a wholly strategic basis. And we, this would be something that would be done with 1 or 2 US investors. But like I said, we'll see how that evolves going forward. We're very sensitive to dilution, as I'm sure most who have been following us understand. We raise exactly how much we absolutely need. We don't go beyond that, because a shitty share price is not exactly something we want to kind of make even worse. So I think if like I said, if we do anything, it will be on a strategic basis only going forward. But that's fine though too, because if those strategics are going to help us get over the line and have revenues come in the door, then there's no reason that at some point down the road we can't start buying back the stock. Always a possibility. And the way that we forecast these revenues to occur, that could happen in very, very short order. So one of our biggest challenges, Martin, as well, is also going to be capacity. So how do we handle large order volume? So in our New York office right now, we've just hired 3 new order entry clerks who are on standby. So when we're live, those people are ready, because there is some documentation to this. You got to have people answer the phones and process the documentation, et cetera, get instructions to Bank of New York Mellon. It's a very intricate system and process. It has a lot of different steps to it, which is one of the reasons why it's taken us so long to get the product to where it is today. Because we've just had to cover off everything from custodial relationships to structuring of the SPV to the structuring of the broker dealer, which was never set up right, but now is, to the actual product itself. You name it, it's been one heavy lift. So when I took over as CEO 3 years ago, I had no idea it was going to be this long. And I'm happy I stayed with it. But at this stage, it's almost anticlimactic, because we've been hopeful for so long that we'd get this sucker done, but now we finally have it done, and it's just like a meh moment. But that being said, you know what? Everyone's going to be made whole on this, and our investors are going to make a lot of money, which will be great. And that's been our guide going forward, just to make people money. So.
A question here from the audience: how much of the company is owned by large investors and management?
I think we own about, so the key insiders and others, I think we own about 90% of the company right now.
Okay.
Yeah.
So that shares out is the float is much smaller. So
yeah, this thing's tight, and our investors, we've been in this sucker nonstop from the beginning, even as a private company. Before it went, kind of pre-public, we've been, a lot of us involved in this thing. So we're in it for the long haul. We're not in it to make beans. We're in this to make mountains. And we definitely see that this company has certainly it has the traction now, and the upward mobility where, I think that's going to happen in short order. So.
All right. Well, on that, let's wrap things up here. I guess the next news coming out of you will hopefully be that you've done your first transaction. Would that be the first news, or you're gone live with marketing, or what would be the next catalyst to look at?
Going live with marketing, we're not going to put out stuff like that. You know what? It's relevant news and credible news only. So Martin, I think you're right. That the minute we have a milestone, we're going to put out news around that. Like I said, our biggest milestone right now is just working with our counsel to get the documentation finalized. But right after that moment, we go live. So yeah, we won't put out any fluff pieces, but I would envision that, every couple of weeks now we'll have new news pieces that we can share with the world. So.
All right, Pat, thanks a lot. That was fascinating. Never seen a story like this before, especially in the small venture cap world. So all the best. Be watching this and looking forward to getting you back to discussing as the business progresses and the transactions start happening.
Awesome, Mark. Thanks so much, buddy. Appreciate
Cheers.
it. Have a great day.
You too.
Cheers.